Welcome to my channel. I'm the cover call guy, and my goal is to hit $120,000 per year passive income. My portfolio currently yields about $70,000 a year and about $6,000 a month. I will be reaching my goal using only cover call ETFs. Legal disclaimer before we start this video. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online, and I could be completely wrong. Now, with that out the way, today's video is going to be on YieldMax. That is because they are making a new ETF suit, right? The PDT25, I just named that for short. They're releasing the performance and distribution target 25. Now, is this going to be the new game changer? Are they finally listening to the shareholders and investors and finally creating an ETF that won't have NAV erosion, can still deliver high income, right? Maybe tax efficient. We don't know. They announced it November 17th, and it will be available to trade November 18th. So guys, should we be concerned? Should we be worried? Should we be happy? Should we buy this? If you are already a YieldMax shareholder, are you buying this? Do you plan to expand your YieldMax portfolio? Are you interested in this? Have you done the research? Please let me know, because I do have YieldMax on my radar. I do want them to do well. I do want them to be able to switch up and release a quality ETF. So, they pay weekly, and I'm trying to add another weekly. So hopefully YieldMax really has listened to their investors. All right, let's get started. All right, I want to start off with critical investors warning. It has a zero performance history, obviously, right? It's going to launch a fund launch November 17th, but the first trade will be November 18th. There is no actual track record right now, so just know there's zero performance history. Just making that clear for the people that's going to say something about it. Unproven strategy, right? Unproven strategy. The growth aware claim is the theoretical and untested in live markets. That's what they're claiming, right? That's in their perspective. Extreme concentration risk. It still has the 100% single stock exposure to volatile tech and crypto stock. As of right now, is still tax inefficiency, unsuitable for taxable accounts right now, because they generate short-term capital gains taxed at ordinary income rates, and that's as high as 37% and possibly more depending on how you guys operate this. Right now, we don't know. It's basically you're working as a W-2 employee, right? Plus the expense ratio. So very highly tax inefficient right now that we know of. Managed distribution. The 25% target is funded by returning a lot of your own capital, which causes NAV erosion. So that's what they're stating. So we have to figure out and see, and give it some time to see if it will actually start eroding like all of the other ETFs. My exclusive summary overview. Once I put this research together, I just want to make it quick and give my little summary overview about the identifications. A new evolved product from the product line of YieldMax, actively managed and list all on the Cboe BZX exchange. Gross expense ratio is 0.99. Exception date is November 17th, and it will be available to trade November 18th. Core mandate versus reality. Primary goal is to target 25% annual distribution, approximately 2.2% a month. Is very good. That's very high. It's very good. We want that. Secondary goal is capital appreciation. The reality is that 25% is a managed distribution policy, not a yield. So it just depends on where that money is coming from, right? We got to make sure they're making the profit. And my key findings from the research so far is that the strategy is a two-part synthetic long call plus short put and income credit call spread strategy. The growth aware analysis that they claim is intentionally collects a lower weekly premium to buy a lottery ticket. which is the long call, right? We call it a lottery ticket because it could work. Long calls typically work out, might not always. It's a 50-50 gamble to reduce NAV drag in the strong bull markets. So they're trying to reduce the NAV erosion. The risk portfolio starkly asymmetric, subject to all potential losses of the stock, while upside is still capped. As of right now, the distribution is 0%. Obviously, it has not been on the market. It will come in the market November 18th on a Tuesday. The tax right now, we have to label it highly inefficient. Does not qualify for 60/40 tax treatment. I don't think they have it in the prospectus. They're just going to go ahead and give it a regular ordinary income tax. All right, so this is the full PDT25 ETF suit. This is all I can find. If I'm incorrect, please let me know. It's the AITT, AMDT, AMZT, ZCONT, MRTT, MSTT, NVIT, PALT, SMCT, and TESS. All right, that one's easy. All right, so this is all the one I can find so far. They are all single stock holdings, so there's the risk with that. Hopefully they do well, because I do want to add another weekly to my portfolio, at least 2 more. So we're gonna have to keep an eye on this and see if they actually keep their word. All right, the growth aware options engine. Just deconstructing the architecture and how it works. 1, synthetic exposure. The fund does not own the stock. It mimics it by buying a leap call and selling a put. This is capital efficient. 2, the engine income. Where's the money coming from? Sells the call spread. Sells a credit call spread. Right, just means sell one call, buy a higher call to generate weekly net premium, which is also trying to capture some upside so it doesn't erode the NAV. Good job on that. And then the collateral. The rest of the cash is held in UST bills to collateralize the short put position and generate minor interest. All right, my picture didn't loan for this one. I couldn't get it. It's basically just these two together, side by side. Is NVIT versus NVDY. So I could just talk it out. It doesn't really matter here. How growth aware is different. Their new strategy is designed to solve the #1 problem of the original fund, the hard cap on gains, which leads to the crazy NAV erosion. The original NVDY sells one call, upside is hard cap, forfeits all gains above the strike. PDT25 NVIT sells a spread, upside is partially capped, can still participate in explosive blow off top rallies. Right, the trade-off, NVIT collects a lower weekly premium to pay for this lottery ticket upside, so it has to balance it. It's a good balance. I really hope their strategy works for this one. I will definitely be adding at least 2 from YieldMax if it definitely holds up. So I'll be keeping my eye on this, and let me know if you guys are too. All right, their strategic payoff comparison. We're just going to compare NVDY versus NVIT. So you can see here they're pretty much kind of similar, except in the upside and premium generation, right? So the upside potential is that the new ETF has a partial cap and gains, resume above the long call strike. The premium generation is lower, but receive only the net premium, right? Sell net premium by cost. So it's trying to balancing it, right? It's trying to reduce potential NAV drag and maintain participation, which is excellent, which is what we want. We don't want the crazy high yield at all costs. That has been proven that it doesn't work, right? That's literally all of their ETFs right now. It just doesn't work. They are paying way too much and not able to make any profits at all. All right, strike selection explained. NVIT. This is just a logic behind how they're gonna operate this. This is just the one stock, right? So based on the prospectus filing, the short call sold anywhere from 0 to 50% out of the money, clustered at 5 to 10%. Long call purchase anywhere from 10 to 20%, further out of the money, 15 to 25% above the strike price. Very good. Love that. That's not bad at all. Right? We don't want to be capping ourselves here. Critical implications, however. The fund only captures upside between $150 to $160, right? If NVIDIA rallies to 170, the fund captures the 150 to 160 move and fully participates in a gain above 160, right? So this requires a 21% rally to happen. In a more common 10 to 15% rally, the fund gains are still capped. As long as, I'm gonna say that's okay, as long as we don't fully cap ourselves in the price, plus we have to pay out some crazy premiums, right? That's not what we want. Lower the premiums, have some upside participation, right? To a certain point, it's okay, right? So I can see this working. I believe Neos does some stuff like this. What others? But yeah, if it's been working for Neos with this similar strategy, I'm hoping YieldMax can execute this strategy just as good. So it will definitely be part of my weekly. The 25 distribution and NAV erosion. We always gotta talk about that, right? The NAV erosion, NAV erosion and YieldMax is synonymous with each other, right? So it's a big thing in the community. All right, fact versus fiction. They're aiming for 25 annualized target. That's what they're aiming for, right? This is a policy, not a yield. The 25% is explicitly noted as a target, right? And what it distributes are not guaranteed. It is a managed distribution policy, a structured withdrawal plan. It is not a 25% yield or a 25% return. The fund pays distribution on a weekly basis. So let's hope it can retain and sustain the 25 on a weekly basis. So that is going to be a rough one. We're going to have to see how they do this. We're going to see how they, I'm sorry, not 25% a week. It will be about 2% a month. So 25% annually. So let's hope they actually maintain this. Because if they do, this is gonna put YieldMax back on the map, right above, like right next to Neos. If anything, even above Neos. Right, source of the yield. We always gotta look where the money's coming from, right? So the 30-day SEC is obviously 0%. It has not come yet, right? The SEC route excludes option income from the yield calculation. The 25% is funded by returning the fund's own capital, which mechanically reduces the NAV. This is just based on the Misty proxy because obviously we have no information from any of the ETFs because it has not officially launched on the market yet. So we do hope it's not anything similar like this. We do hope the return on capital is going to be Slater and they can make actual profit, right? Even if it's taxed higher, we want to see that they're making profit. That's good sign. Even yes, it's a little bit more tax efficient, but we're seeing that they can actually make profit on these options income. That's a good sign. That's good. We love that. That's what we should be hoping YieldMax can do. Now if it's like damn near 96 to 100% rock, right? Now you can get worried, especially these new funds, because we don't want these new funds to be just giving the money back for accounting purposes or tax purposes, right? Make the options premium, the income, distribute that and do that on a consistent basis, and that will build confidence for the investors. Of course, we're going to talk about the number one risk, right? The structural NAV erosion. Prong 1, erosion by distribution. Like I said, the fund eats itself to make 25% payment. We don't want that. I mean, if it happens to this ETF that YieldMax is putting out, YieldMax is going to 100% collapse and it's going to get liquidated. No one's going to invest in this. The outflow is already hurting them a lot, right? Nobody's putting money back in. Prong 2 is erosion by ratchet effect. That just means the fund captures 100% of the downside, but only a fraction of the upside recovery. After a drop in recovery, the stock is flat, but the fund is down permanently, which we've seen with a lot of their ETFs, right? So if these two happens, Prong 1 and Prong 2, YieldMax basically you can kiss it goodbye. The ratchet in effect, again, this picture didn't load for me. I try to keep uploading it, but PowerPoint just not taking it. All right, the historic validation, I use QYLD for example. All right, the ratchet effect is not theoretical. Theoretical, right? Theoretical. Look at QYLD versus QQQ. Right, in the 2022 bear market, QQQ stock dropped 33%, QYLD dropped 27%, cushioned by premiums. In the recovery, QQQ completely crushed them, right? QYLD only captured 18%, 35% of the recovery. Result, QQ recovered its 2022 high, and QYLD remained at 25% below its peak. So that is the ratchet effect, whereas pretty much you've seen almost 90% of YieldMax ETF. With these new ETF, we pray we don't see them. The growth aware asymmetry, right? This is my concluding analysis. The benefit materialized only under specific conditions, right? A sustained powerful bull market. Right now, going down with the past few days, going maybe possibly this entire week, we're going to see this really hit the YieldMax ETF hard, and we're going to have to see them rebound, right? In the choppy range bound or moderately bullish market, the growth aware benefit is minimal, while the cost, which is the reduced weekly premium, is constant. So again, this is what they're aiming for. This was in their prospectus, the growth aware. So hopefully, I'm praying for them. I'm hoping YieldMax does well with this one, because this is pretty much their final straw. All right, buried risk and performances. Buried risk, and this comes from the prospectus, right? One, they said no guarantee of upside, obviously, with almost everything, no guarantees. Two, weekly rolling risk, right? The fund must close and reopen its entire option structure weekly. Transaction costs and bid-ask spreads create a constant drag on the performance. That's just how weekly ETFs are, right? That's one of the downsides to it. You get paid weekly, but they constantly have to create that constant drag on performance. Three, counterparty risk. Options are subject to counterparty risk. In a liquidity crisis like 2008 or 2022, the fund may be unable to close position favorably. I mean, a lot of cover call ETFs have this issue. And then, of course, what it distributes can always get cut, right? The prospectus especially states that distributions may be reduced, suspended, or eliminated if volatility collapse or the stock enters a downtrend. So this is one of the big issues, because we are right now in a downtrend. And then volatility regime dependency. High IV, when the VIX is over 25, it's good. Collects larger premium. Bad high IV usually means high downside volatility, which obviously these ETFs is going to take on the full downside. Low IV, the VIX is below 15. Bad, it collects smaller premium, threatening the 25% target, right? May be forced to cut distribution or accelerate NAV erosion. We're going to see how they play out. We're going to see it. And then we want the Goldilocks scenario, right? This strategy optimized for a narrow band, moderate to high IV, plus strong upward price performance. This is rare. It doesn't happen often, but when it does, we will see cover call ETFs shine. Almost like 99.9% of cover call ETFs will shine. Performance disclaimer and proxy data. Disclaimer, zero history, right? I have to put that out there. It has zero history. Obviously, I have no information, just what they're going off and what they're telling us. So an analysis is just based on going off on their possible strategy, plus I can only use data what their ETFs has already been out to. And of course, the update required is that as of November 17th, 2025, the first weekly distribution has not been declared. I think they're expecting December 1st. Yeah, if it opens 18, they'll probably declare around the week of December, or the week before that, just before December hits. Analysis is needed to compare. So we don't have anything yet. Proxy data, total return underperformance. We can only use basically what they already have right now. This is just data and ETFs from what they have. So if we can get a look at their previous and current ETFs, then it's going to be a scary performance. But we're hoping not to. Scenario analysis: when does PDT25 actually win, right? So it wins in a crash slightly, bear market slightly. This is against its own ETF, which is NVDY. So In a sideways market, it does not win. In a mild bull, it does not win. In a strong bull, where I'm thinking, this is obviously based on illustrative purposes, right? So, um, in a strong bull market, I think the new ETF is going to win. In an explosive market, I want to say the new ETF will also win. The only way it doesn't win is in a like very very sideways to mild bull against NVDY. That's just against this ETF. If it was against other ETF, it's just gonna be much harder for me to have an illustration just because it has no data, right? So I'm basing it off of what YieldMax is telling me. So I'm hoping their new ETF, they execute the strategy perfectly, because it's gonna be tough. All right, tax nightmare, my final verdict. All right, the tax nightmare. There is no 1256 contract that was mentioned. Right, these single stock options do not qualify for favorable 60/40 tax. So tax drag is going to be terrible on this. Short-term gains, right? All gains from options are taxed at short-term. I think short-term is as high as 37 to 40%. Yeah, it's around maybe less. Anyways, just think of it as a W2. Yeah, it's as high as 37% for short-term gains. And then of course we have to worry about the destructive rock, just because destructive rock NAV erosion is synonymous with YieldMax. So that's always going to be the biggest issue, right? You can go anywhere. You can go on YieldMax's X official account, and they'll post something in the comments. Will be saying, hey, I'm a shareholder and you guys got to fix this. What's happening? You can go on the Reddit community and in the YieldMax Reddit community, and you'll see, the people complaining and posting, and it's a nightmare, right? For the most part, for the most people, not everyone. I know a lot of you guys do post comments saying, hey, I'm basically break even in the next payment, and I'm gonna be up. It's gonna be house money. I wish nothing but the best for you guys, right? I hope you guys at least make all your money back, and if you want to break even, then break even. If not, then I hope you guys, don't have to reinvest to get all your money back after that, because that is another issue. If you have to reinvest everything just to break even or get a little bit ahead, then that's just another red flag in my opinion. So back to destructive rock before I go off topic here, right? Let me just talk about this. Rock is tax deferred, not tax free. It reduces your cost basis, or when rock payouts exceed the fund's earning, it becomes destructive rock, permanently eroding your principal. And of course, I want to put alert for retirees, right? Those who can actually get Medicare. If you're an American in the United States, right? What is IRMAA? It just means income related monthly adjustment amount. Is a surcharge on Medicare Part B and D premiums for high income retirees. Is based on your MAGI from 2 prior years. While ROC 95% does not increase MAGI, the short term capital gains 5 to 10% do count towards MAGI, right? You don't want it to count as income. You want to make $150,000 a year return of capital, and on paper you made nothing. And I'm just using $100,000 investment example, 25,000, 25, which is 25% annual distribution, right? Not 2,375 and $750. 95% of ROC, no MAGI impact. The 1,250, 5%, yes, right? Increases MAGI. All right, so this is a warning. This ratio can fluctuate in volatile years. The short-term capital gains portions could spike and push you into a new bracket, right? You got all that dollar bill to spend. That's how Uncle Sam sees it. And then of course I want to put it next to a competitor, because I really want YieldMax to do well. I want them to be held as high in regards as NEOs. So I hope that PDT25 is going to end up being in the green Right now it's in the red because we still have no information, and from its perspective, it's an extremely single stock concentration. As of right now, I'm gonna say it's highly inefficient for taxes. The yield is very aggressive and the fee is very high. So we hope that that changes going forward. And then there's just an income strategy comparison chart, right? So PDT25, NAV stability, I'm still going to put it very low right now. Tax efficiency, very low. Diversification, none, since it holds single. So as of right now, it's just best for the speculators. I'm going to be on a sideline and I'm going to just start watching how they actually execute. And these are just against NVDY, JETB, QYOD. And of course, we gotta talk about the psychological trap for anybody's new to cover call ETFs, and they just get into the yield max, right? These funds are engineered to appeal to common behavioral biases, which can lead to poor investment of decisions. Which just means when you're new, and you get into the cover call space, the first thing you see is what? The yield, right? And then that tricks you into, oh my god, I can get so much money based on this income, blah 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 blah. I can retire in 3 years, right? Recency bias. Investors see the 2024 to 2025 rallies in stock like Nvidia and expect them to continue, right? The PDT25 strategy is designed to win in that specific market, but loses in most others. Is what I think could happen. The yield illusion, like I said, right? Don't be fooled by the 25%. We have to know where that yield is coming from, where that money is coming from, right? It has to be sustainable. And then, of course, sunk cost fallacy. After new erodes, investors refuse to sell. I'm down 30%, but blah, 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 right? At least I'm getting paid, blah, 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 blah. But you're not really getting paid. You're losing everything. And then, of course, we got to talk about the taxes, because why would we work so hard and do all this just to give money back to Uncle Sam? I don't know. Maybe some people like that, but not me. If that's you, let me know if you like giving money to Uncle Sam, because you can just give it to me. Fundamental questions, right? Why would a rational investor accept 100% downside risk and cap upside, 25% annual NAV erosion via distribution? Possible. Punitive tax treatment, tax drag, a 0.99% expense ratio. It could be worth it. It could not be, right? Why would you do this in exchange for weekly cash flow that is primarily the own capital return? Is the fundamental questions. We will have to see how YieldMax proves me wrong, and I hope they do. I'll make a video on that. They prove me wrong, I'm wrong, I'm an idiot. My final verdict: these are trading, as of right now, these are trading instruments, masquerading as investment products. Avoid if you are a long-term buy and hold investor, a retiree seeking capital preservation, and investing in a taxable account as of now. It could be great for a taxable account depending on how they perform. I want to say it's only suitable for the speculators, a short-term tactical trader, and exclusively and somewhat a tax advantage account if they start eroding. So hopefully they don't. I'm praying for them, right? And then this is just an addendum. I wanted to ask, why aren't these in the YMAX YMAG, right? And then I just said product cannibalization. I just asked this question. This is just an informed slide. These are some questions I asked, and I just did some research on it, and I just put it in just for educational purposes. One, product cannibalization. YieldMax is deliberately segmenting the market, right? YMAX equal maximum income, while the PDT25 equal growth aware income, right? They're two separate products. Performance divergence in the bull market, PDT25 are designed to outperform the original funds in YMAG. I was like, okay, that makes sense, right? So they didn't include the maximum income goal of YMAG. And then investor confusion. I think YieldMax has a lot of products. It's just adding too many niches, and they gotta find specific spaces for specific investors. And I don't think they don't want to mix it. If you go on the website, they have it's a very fancy, good marketing website for YieldMax, but it can also get very confusing. Questions? If you found this analysis helpful, please like, comment, subscribe. I think I forgot to add that. Oh geez. All right. Yeah, I forgot to add that. I don't know what the heck happened. Anyway, if you found this analysis helpful, comment, like, subscribe. Let me know your thoughts. Again, I really do hope YieldMax do well with these ETFs. As myself, I'm looking for to add at least 2 new weekly pairs. So hopefully YMAX and these ETF do perform well. Thanks for watching. Stay tuned. Catch you guys on the next.